What's going on in the Temecula Valley housing market, and how is the Silicon Valley bank failure going to affect real estate? Pretty interesting trench report today. I'll give you all the details. Let's get to it. Hi, I'm Jessica Genung with the Genung team in Active Realty. I'm married to Chris, also a realtor. We work as a team and we have two boys, ages 5 and 7, and a border terrier named Zoe. I've mentioned in previous videos that I'm expecting. I'm about 7 months along, and this time it is a girl, and we're excited about that. I'm due in mid-May. Despite the new addition coming soon, we are still working hard over here, and I'm super thankful to have the help of our awesome team, Chris, Christina, and Scott, who have been doing a great job lately, especially because it's been pretty busy. So appreciative for the team. Let's do a quick recap of the current environment. This month, we are seeing some signs of stabilization in our local housing market. For many months, prices have been on an overall downward trend, but this month's prices are leveling out. Median days on market are trending down, which is typical seasonally as we head into the spring selling market. What is not typical is that our number of listings, our inventory, is decreasing pretty dramatically, which is my biggest housing fear, and I'll explain why. Month-over-month decreases in number of listings in all 3 cities we analyze, Menifee, Murrieta, and Temecula, are down 16 to 19%, which is a pretty big month-over-month decrease. This is my biggest fear because we all saw what happened with home values and affordability during the first 2 years of the COVID shutdowns, during which time we had historically low inventory. The boom in housing was also caused by many other contributing factors, including big government stimulus packages and new remote workers that were now allowed to work from anywhere. After the Fed more than doubled the interest rates last year, that priced a lot of buyers out of the market, and prices started to stabilize and drop in many areas. The Temecula Valley saw home prices decline at a faster rate than the national average. This is because we increased more during COVID than the average city, because so many folks were wanting to relocate here due to the high quality of living we enjoy, local area amenities, high-ranked schools, and our awesome Southern California weather. But the cities nationwide that increased faster than others started to see a faster deceleration than those cities that were not seeing as much of a new population influx. A mini boom and bust, if you will. The other reason we saw a big boom during COVID, and the reason we have been seeing housing prices increase steadily over more than a decade, even prior to COVID, is because of a huge nationwide housing shortage. Let's look at this CNN business article. There is a sizable shortage of new homes after more than a decade of underbuilding relative to population growth, according to a new analysis from Realtor.com released Wednesday. The gap between single-family home constructions and household formations grew to 6.5 million homes between 2012 and 2022. Now I'm going to briefly explain what they mean by household formations, new household formations. So if you take your typical family, you've got your mom and your dad and a couple kids, and they're all living in one house. Well, now one of the kids is ready to move out. Maybe they're going to get married and they are going to need another house. So an additional household formation will be formed. So household formation continues to outpace building in a major way. What does all of this have to do with the Silicon Valley bank failure? SVB experienced a classic bank run, and the response of the FDIC over the weekend was massive, saying they will be insuring all depositors. This bold move, not saying it was the correct move, time will tell, but it has calmed the markets for now. The Dow Jones is up over 1% today as I write this commentary. You might be asking, what does all of this have to do with the housing market? Let's look at this Yahoo article. Mortgage rates tumbled Monday in the wake of Silicon Valley Bank's collapse that has rattled markets. The average 30-year mortgage rate dropped to 6.57% on Monday, according to the latest Mortgage News Daily Quote. That's down from 6.76 on Friday when SVP failed, and 7% on Thursday when the bank stock got hammered. The rate tracks the 10-year Treasury yield, which has fallen around 30 basis points since Wednesday's close, as investors bet the unfolding chaos could persuade the Federal Reserve to slow its interest rate hiking campaign. The bank failures are very recent news, so time will tell how it plays out in the long run, but home buyers are very sensitive to fluctuations in the mortgage rates, and even just a 0.5% drop in rates can give buyers 5% more purchasing power. When the rates were trending down in December and January, I saw clients being able to lock rates in the 5s again. That really seemed to pick up the market, and especially in new construction, they sold through a lot of standing inventory that was taking longer to sell. So the Fed meets again on March 21st. I believe the general consensus is that they will only raise the rates 25 basis points, and some are even saying they might hold steady after the bank failures. So we have mortgage rates falling into a national housing shortage. We are especially short on housing in California, and given these dynamics, I'm concerned we could end up back in another unhealthy buying frenzy. What say you? We love to hear different opinions down below in the comments, and don't forget to subscribe to the channel if you want to keep up to date on our local housing market. This video is a trench report where I give you the feel of the market from the boots on the ground. It feels like things are picking up as we move into the spring selling season. Our clients are noticing that homes they're interested in are going pending faster, which is reflected in the market stats we download and study monthly. And to the disappointment of buyers, we are seeing more multiple offer situations. Not like before, where it was not unusual for a popular listing to get 10 plus offers, but more in the 2 to 3 multiple offers range. My 2 most recent listings had multiple offers. Also, transactions are much more difficult as of late, with some sellers disappointed they have missed the peak and are still wanting to get the best price and terms despite the market decline. Buyers who are stretched by high payments due to the interest rates are also wanting to get the best possible deal in terms. It's an emotional time to be in the housing market, but it's a different kind of emotion than we experienced during the COVID home buying frenzy years. The good news for buyers is it is easier to get into a home and get an offer accepted with less buyer competition, but it comes at the current higher interest rates. I'm seeing beautiful pool homes that were flying off the market a year ago get price reductions. I saw a really nice one this morning on my Facebook feed listed by an agent in my network get a $40,000 price reduction. The good news for sellers is that homes are still selling that are priced correctly and that have been properly prepared for sale. The bad news is that it does take some extra effort on the seller side, which is why we are more likely to recommend new paint and carpet and possibly some staging as well to help the properties sell quickly. Buyers don't have extra in their budget for even cosmetic updates lately. That wraps up the trench report. Thanks for watching. Bye.